What happens when the world's largest authoritarian economy decides it's time to quietly kneecap the global currency? Behind the polished podiums and campaign rallies, far from the American political theater, a quiet financial storm is gathering strength, one that could shake the very foundations of U.S. economic power. As former President Donald Trump seeks a triumphant return to the White House, a new and far more dangerous battle is unfolding, not in Washington, but in Beijing. China, the United States' biggest geopolitical rival, has just made a bold and deliberate move that threatens the dollar's supremacy. It is selling off U.S. Treasury bonds, not slowly, not quietly, but with force and timing that can only be described as surgical. This isn't just economic repositioning, it's a warning shot, and it could be the beginning of something much larger. The U.S. dollar has been the king of global currencies for decades, backed not only by military strength, but by deep trust in America's economic institutions. Treasury bonds, those safe government-backed IOUs, have been the preferred asset of countries looking for stability. China has long been one of the top holders of these bonds, parking its vast foreign reserves in the heart of the U.S. financial system. That trust is now unraveling. In the last few months, Beijing has escalated its offloading of U.S. debt, reducing its exposure with a level of consistency and determination that has analysts alarmed. Over $50 billion in treasuries have been sold, and the message couldn't be clearer. China is preparing for a future where the dollar may no longer be the center of the financial world, and it's doing so while the United States is distracted by internal chaos, election drama, and fragile economic recovery. This move isn't coming in a vacuum. It's coming at a time when U.S.-China relations are spiraling. Tariffs, tech bans, Taiwan tensions, and ideological confrontation have poisoned diplomacy. Now, China is taking the battle into the bloodstream of the American economy, and for Donald Trump, the timing couldn't be more volatile. He's building his 2024 campaign around a promise to restore American greatness, especially through a booming economy. But what happens if the economic indicators begin to slip? Inflation resurges, or the Federal Reserve is forced to respond to China's bond sell-off with emergency measures? What if voters begin to feel the pressure in their wallets, not from domestic policy, but from foreign financial warfare? This is the quiet crisis no one is talking about yet. While headlines focus on polling numbers and indictments, a slow detonation is unfolding beneath the surface of the global economy. And its epicenter may be a calculated economic offensive from Beijing, designed not only to destabilize the US dollar, but to rewrite the rules of global finance, just in time to reshape American political momentum. Because this isn't just about selling bonds, it's about economic sovereignty. It's about signaling to the rest of the world that the dollar, long seen as unshakable, can, in fact, be challenged. And when China sends that signal, the world listens. What comes next could redefine the balance of power in ways we haven't seen since the Cold War. And yet, the American public remains largely unaware of how vulnerable their economy has become, not just to domestic dysfunction, but to coordinated foreign pressure. China's sudden dump of U.S. Treasury bonds. It wasn't a leak. It wasn't a rumor. It was a calculated strike, silent, surgical, and designed to send shivers through Wall Street without firing a single shot. China's decision to rapidly reduce its holdings of U.S. Treasury bonds wasn't just another fiscal maneuver buried in central bank data sheets. It was a geopolitical message written in the language of markets, and the world has begun to decode it. In just a few months, Beijing has shed over $50 billion in treasuries, its most aggressive retreat from U.S. debt in years. And yet, most Americans have no idea what this means, or how deeply it could cut into the country's financial stability. For decades, US Treasury bonds have been the gold standard of safe investments, a symbol of America's fiscal strength, global trust, and unshakable creditworthiness. They've underpinned everything from global pension funds to the monetary strategies of central banks. And China, as the second largest foreign holder of this debt, has used treasuries both as an investment tool and a political lever. So when it starts selling at this scale, the world pays attention. The timing is no accident. As geopolitical tensions rise, particularly over Taiwan, tech restrictions and trade imbalances, China is signaling that it's not afraid to weaponize finance. By shedding US debt, Beijing not only reduces its exposure to a potential financial Cold War, but it also plants a seed of doubt. What happens if other nations follow suit? What happens if confidence in the dollar, the lifeblood of global trade, begins to erode? There's something chilling in the silence surrounding the move. It wasn't broadcast in state media as a chest-pounding victory. It was done quietly, precisely, in a way that only insiders would notice at first, as if China wanted to send a coded message to Washington without alarming the global system too early. A message that reads, "We're repositioning. We're preparing for a world where US dominance is no longer guaranteed, and if need be, we can shake your financial core without firing a missile or launching a cyber attack." And here's the most unsettling part. This could just be the beginning. China still holds over $800 billion in treasuries. That's enough to keep the threat alive, to keep US policymakers uneasy, and to keep investors questioning just how safe the safe asset really is. It's a lever that can be pulled slowly, painfully, and with maximum psychological effect, especially during an election cycle when economic stability is on the ballot. Donald Trump, known for his economic bravado and anti-China rhetoric, now faces a subtle but powerful counterpunch. If markets begin to tremble, if yields spike, if foreign investors hesitate, the narrative of economic strength could collapse like a house of cards. And the worst part, the average American wouldn't even see it coming. They won't trace higher mortgage rates or falling 401ks back to Chinese bond sales. But the pain would be real, the timing would be brutal, and the impact would be political. This is financial warfare disguised as monetary policy. It's the art of applying pressure without provoking open conflict. It's how superpowers fight in the 21st century. No tanks, no troops, just cold economic calculus and a slowly ticking bomb buried deep in America's debt structure. A direct blow to the heart of US financial stability. The real danger isn't just what China is doing, it's what that move reveals about the deeper cracks forming inside the architecture of the American economy. When the world's second largest economy starts unloading US treasuries, it's more than just a portfolio adjustment. It's a signal to global markets, a whisper spreading from Tokyo to Berlin to Riyadh. The foundation isn't as unshakable as we thought. And that foundation is the very thing holding up the illusion of American financial invincibility. Treasury bonds have long been treated like gospel in global finance, a no-risk, high-trust asset backed by the full faith and credit of the United States government. But faith is fragile, and credit, even from a superpower, depends on perception. The moment that perception starts to shift, everything else begins to wobble. That's what makes China's actions so devastating. Not the immediate economic ripple, but the long-term psychological tremor. When confidence breaks, it doesn't need to shatter loudly. It just needs to slowly erode until one day it's gone. Right now, we're watching that erosion in real time. As China exits the bond market, yields climb. That might sound technical, but it has massive real-world consequences. Higher yields mean higher interest rates across the board, on credit cards, mortgages, student loans, and business borrowing. It means the US has to pay more to finance its own debt, which is already spiraling past $34 trillion. And in an election year where both parties are scrambling to promise economic miracles, this kind of pressure exposes just how limited those promises really are. Imagine the Fed, already caught between inflation and recession fears, being forced into action because of something entirely out of its control, a foreign sell-off that makes borrowing more expensive overnight. Monetary policy becomes reactive, not proactive. Fiscal policy becomes a balancing act on a tightrope that's swaying in the Beijing wind. And in the middle of all this, millions of ordinary Americans who have no idea why their financial lives suddenly feel more unstable. This is the invisible battlefield of 21st century power. You don't need tanks to destabilize a nation. You just need leverage over its economy. And US debt, paradoxically, has become both a weapon and a weakness. For years, it gave Washington the ability to finance wars, fund bailouts, and promise prosperity without raising taxes. But when that debt is no longer seen as desirable, the consequences come crashing back with brutal clarity. That's what makes this moment so dangerous, not just for policymakers, but for the people who trusted that the system would always keep them safe. China understands this better than anyone. They're not just selling bonds, they're shifting narratives. They're turning the US financial system's greatest strength into a potential liability. They're planting doubt, not just about American leadership, but about American solvency. And in a world that's already experimenting with alternative systems, BRICS alliances, digital currencies, de-dollarized trade, that doubt is a spark in a room full of dry kindling. There's a reason financial analysts are watching central bank movements more closely than election polls. Because markets respond to perception faster than politics can react. And right now, the perception is changing, quietly, steadily, perhaps even irreversibly. The question isn't whether China's actions are hurting the US economy. They are. The real question is, how far will this go? And what happens when other countries begin to view US debt not as a safe harbor, but as a risk? Why now? The strategic timing behind the move. There's a saying in geopolitics, timing is never random. When a move seems sudden, it usually isn't. It's been planned, calculated, and calibrated behind the scenes, waiting for the perfect moment to strike. China's accelerated sell-off of US Treasury bonds didn't happen in a vacuum. It happened now for a reason. And to understand the full weight of this action, you have to look beyond the numbers and into the strategic chessboard Beijing is quietly moving its pieces across. At surface level, it might appear to be a response to deteriorating US-China relations. And while that's part of the story, it's far from the whole picture. The timing of this financial maneuver is deeply tied to global shifts, US political volatility, and China's long-term vision of economic independence and influence. Right now, the United States is at one of its most vulnerable moments in decades. Domestically, the nation is politically fractured, with a highly polarized electorate and a former president preparing a dramatic comeback campaign. Economically, the US is walking a tightrope. Inflation, high interest rates, slowing growth, and rising debt are all part of a precarious balancing act. China, observing this turbulence, chose this moment not just to protect its own reserves, but to apply pressure while the US is distracted and divided. Beijing knows that selling treasuries isn't just about reducing exposure, it's about triggering reactions. The bond market is a reflection of trust. When a major holder pulls back, it can lead to ripple effects. Investors get nervous, yields rise, and the cost of borrowing spikes. This is especially dangerous during an election year, where economic perception is as critical as policy itself, and China understands American politics better than many give it credit for. It knows that if the economy shows signs of distress, even slightly, it can dramatically shift voter sentiment. The narrative of financial strength is fragile, and timing the disruption of that narrative is a play pulled straight from the geopolitical playbook. But there's another layer. While the US is focused inward, dealing with culture wars, legal battles, and partisan chaos, China has been expanding its influence globally. Through the Belt and Road Initiative, partnerships with BRICS nations, and increasing trade in non-dollar currencies, Beijing is laying the groundwork for a new financial order. one where the dollar no longer reigns supreme. Selling US debt isn't just an economic move. It's a signal to allies and neutral countries that the time to diversify away from the dollar is now. It's about undermining confidence in the current system while offering quiet alternatives. This shift isn't just happening in the shadows. Central banks around the world are already starting to reduce their dollar holdings. Nations are engaging in bilateral trade deals using local currencies. Russia, India, Brazil, all part of a slow-moving but deliberate migration away from the dollar-dominated system. China's sell-off amplifies this movement, encouraging others to act while the US is too distracted to notice. And the fact that it's happening during a key election cycle isn't a coincidence. It's a strategic decision meant to exploit America's weakest points. Even China's own economic slowdown plays a role in this decision. With domestic growth struggling and real estate markets under pressure, Beijing needs to strengthen internal stability. Reducing reliance on US financial instruments is part of a broader plan to insulate itself from future sanctions or financial warfare. It's a lesson learned from watching Russia get cut out of the SWIFT system, its dollar assets frozen in retaliation for war. China sees the writing on the wall and is making sure it doesn't end up in a similar position should tensions escalate further with the US or its allies. The strategic calculus extends beyond finances. Timing this move while the US is diplomatically stretched, dealing with multiple international crises, military aid commitments, and strained alliances, gives China more room to operate with minimal resistance. It creates space for Beijing to expand its sphere of influence while casting doubt on the dollar's long-term stability. And once that doubt is seeded, it becomes incredibly hard to contain. Because unlike missiles or cyber attacks, economic pressure doesn't make headlines overnight. It builds, it spreads. And by the time it's acknowledged, it's already deep in the system. This is not a panic move by China. It's patient, precise, and perfectly timed to hit the US where it's least prepared, its sense of financial invulnerability. It's a reminder that power in the 21st century isn't just about military hardware or diplomatic summits. It's about control over trust, over systems, over timing. And right now, China is showing the world that it knows exactly how and when to pull the levers that shake the core of that trust. Do you think this timing was a coincidence? Or is China playing the long game with perfect precision? How this weakens the dollar, quietly but deeply. The erosion of a currency's dominance doesn't begin with a crash. It begins with a shift in confidence, quiet at first, almost invisible. It begins in the back rooms of foreign central banks, in closed-door meetings between finance ministers, in whispered memos about exposure and diversification. And right now, those whispers are growing louder. China's sell-off of US treasuries isn't just a statement. It's a mechanism of quiet destabilization, because every bond sold isn't just a number on a spreadsheet. It's a message to the world. The dollar is no longer untouchable. That message is beginning to stick. For decades, the US dollar has functioned not only as the global reserve currency, but as a symbol of trust, of reliability, of order. Countries hoarded it, traded in it, and saved in it, because the dollar represented a world structured around stability. But that image is cracking. China's strategic retreat from dollar-backed debt injects a level of doubt into a system that depends entirely on perception. The dollar is only dominant as long as the world believes it is, and that belief is now being tested. Every sale of US bonds by a major economy creates pressure, not just on interest rates or inflation, but on the symbolic weight of the dollar itself. Investors begin asking different questions. What happens if more countries follow China's path? What happens if the diversification trend accelerates, with nations building reserves in euros, yuan, or even digital currencies? What happens when the dollar is no longer the default, but simply an option? This isn't theoretical, it's happening. Several nations are already reducing their dollar exposure. From Saudi Arabia engaging in oil deals outside the petrodollar system to India and Russia trading in rupees and rubles, the cracks are no longer invisible. The de-dollarization trend, once dismissed as a fringe idea, is now a reality being quietly implemented by some of the world's most influential economies. China's actions give this movement weight. They show that leaving the dollar isn't just a political statement, it's a viable strategy, and the consequences inside the US could be profound. As foreign demand for treasuries declines, America will have to find other ways to finance its ever-expanding debt. That likely means higher interest rates, more expensive borrowing, and deeper fiscal strain. It could mean economic slowdowns, tighter credit conditions, and a greater reliance on domestic buyers, who may not be prepared to absorb the volume at the scale and price needed. This silent weakening of the dollar touches everything, from the strength of the stock market to the cost of food and fuel for everyday Americans. What makes this even more dangerous is how subtly it happens. There's no single headline, no sudden flashpoint. The dollar doesn't collapse overnight. It slips. Gradually, a shift here, a policy there, another country opting for an alternative system, and by the time it's recognized as a pattern, the shift is already embedded. China knows this. That's why it's acting now, not in an explosion of defiance, but in a steady, methodical retreat. The psychological impact is equally important. As the dollar's aura of dominance fades, so does American leverage. It becomes harder to enforce sanctions, to dictate trade terms, to influence global institutions. A weakened dollar means a weakened geopolitical voice. It means the US may still have the military, but less financial firepower to back its strategic decisions. And this change, driven quietly by bond sales and foreign bank decisions, could reshape international dynamics in ways that no war or summit ever could. Implications for Trump's 2024 comeback narrative. As the psychological grip of the dollar loosens on the global stage, the ripple effects are not just financial, they're deeply political, and nowhere is this more evident than in the narrative architecture of Donald Trump's 2024 campaign. His return to the spotlight has been engineered around a singular, dominant promise: to rebuild American greatness through economic strength. But what happens to that narrative when the very symbol of US economic supremacy, the dollar, starts to show cracks under international pressure? What happens when the bond market, once seen as untouchable, begins sending signals of stress driven by foreign moves beyond any president's control? Trump's brand has always been rooted in the idea of control: strong borders, strong deals, strong leadership. He positioned himself as the businessman president, the deal maker who could outmaneuver foreign leaders and force the world to respect American power. But the economic battlefield of 2024 looks very different from 2016. This time, the threat isn't about factories leaving for China or unfair trade terms. It's deeper. It's structural. It's about global confidence in the US itself. And that's a much harder thing to control with rhetoric alone. If interest rates keep climbing due to falling foreign demand for US debt, it won't just be numbers on a chart. It'll hit home for millions of Americans. Mortgages will rise. Credit card interest will increase. Business loans will tighten. The economic feel-good factor that campaigns desperately rely on could evaporate faster than expected. And here's the key detail: this won't be easily blamed on internal policy. It won't be a partisan issue. It's a consequence of global repositioning. It's China, and perhaps other nations, slowly pulling the strings behind the curtain while America argues over culture wars and court cases. And that's where the real danger lies for Trump. His supporters expect strength, predictability, dominance. They don't want to hear about vulnerabilities, especially ones linked to foreign actors. But economic stress caused by international moves, like the sale of US bonds, will force a confrontation between political promises and economic reality. If the financial strain grows louder in the months ahead, Trump may have to either reframe his message entirely or risk being seen as out of touch with a new global financial order that no longer bends as easily to American will. This isn't just speculation. You can already see the signals. Bond yields creeping up, inflation lingering despite tightening, the Federal Reserve caught between conflicting pressures. These are not isolated events. They're symptoms of a changing landscape, and that landscape is shaped in part by the very forces Trump vowed to confront during his first term. Ironically, it may be China's quiet financial assault, not tariffs or trade deficits, that poses the most serious challenge to his comeback. For voters, this creates a deep psychological tension. The economy is no longer just about jobs or gas prices. It's about something more abstract, more existential: confidence. Confidence in the system, in the currency, in the future. And when that confidence is shaken, it's hard to restore. Trump's messaging machine is powerful, but even it may struggle to spin rising borrowing costs and fragile markets as part of a winning strategy, especially if the public begins to sense that the US is no longer dictating the global terms of engagement. At its core, this is no longer just an election about red versus blue. It's about America's position in the world, about whether the next president can navigate not just domestic challenges, but a new global order quietly engineered by rivals who have learned that brute force is no longer necessary to shift power, just timing, patience, and the ability to move when the US isn't looking. Is de-dollarization accelerating? If there's one question echoing through the corridors of finance ministries, global banks, and even elite political circles right now, it's this: is the world finally moving away from the dollar? What once seemed unthinkable, even laughable, is now being discussed openly at international forums, in BRICS meetings, and within bilateral trade negotiations. The idea of de-dollarization, long dismissed as a fringe concern or an unrealistic geopolitical fantasy, has gained not only traction but momentum. And China's decision to sell off US Treasury bonds may be the clearest signal yet that this is no longer a theoretical trend. It's an emerging reality with far-reaching consequences. For years, the dominance of the dollar has been the invisible engine of American power. It allowed the US to borrow endlessly, to sanction enemies with precision, to influence international markets almost by reflex. But that power, while vast, was never absolute. It depended on compliance, on a global belief that the dollar was safer, more reliable, and more liquid than anything else. Now that belief is beginning to erode, slowly, strategically, irreversibly. You can see it in the way countries are reconfiguring their trade structures. China and Russia now conduct most of their transactions in yuan and rubles. Brazil and Argentina have discussed creating a shared currency for South American trade. The UAE and India recently settled oil trades without using a single US dollar. These are not isolated incidents. They're part of a deliberate diversification strategy by emerging powers to escape the gravitational pull of the dollar-dominated system, a system they increasingly see as vulnerable to weaponization. This is where the ripple effects of China's Treasury sell-off become even more profound, because the act itself isn't just economic, it's symbolic. It tells the world that even the biggest players are planning for a future where US assets may no longer be the centerpiece of their financial strategy. And when one major player moves, others take notice. Central banks across the globe have already begun shifting their reserve compositions, increasing their gold holdings, and experimenting with digital currencies issued by national banks. It's a quiet vote of no confidence, not just in US policy, but in the very foundations of the post-Bretton Woods financial order. And this transformation isn't happening in a geopolitical vacuum. The rise of multipolarity, where several regional powers compete for influence instead of one dominant hegemon, has created the perfect environment for de-dollarization, to accelerate. The more fragmented the world becomes, the more incentive each player has to create systems that protect them from centralized financial control. That's why we're seeing the development of new cross-border payment systems like CIPS in China, Russia's SPFS, and even blockchain-based mechanisms aimed at bypassing SWIFT entirely. These platforms aren't just technical alternatives, they're strategic weapons in a new kind of economic warfare. What's alarming is that the US seems ill-prepared for this shift. While political leaders argue over budget ceilings and culture wars, the financial world is undergoing a quiet revolution, the kind that doesn't make headlines until it's already irreversible. And it's not just adversaries like China or Russia driving this change. Even traditional allies are exploring escape routes. France recently completed its first LNG trade in yuan. Saudi Arabia, long seen as the guardian of the petrodollar, has expressed openness to selling oil in currencies other than the dollar. If that domino falls, the implications could be seismic. Because the petrodollar system is the spine of the dollar's global dominance. If major oil producers begin to accept payments in other currencies, it reduces global demand for dollars overnight. That means less need to hold dollar reserves, fewer incentives to buy US debt, and ultimately, a weaker dollar that can no longer command the same influence it once did. It's a chain reaction, and China's actions have already helped set it in motion. What makes this even more dangerous is how slow and stealthy the process is. There's no breaking news alert when a central bank reallocates a portion of its reserves. There's no televised press conference when trade partners agree to switch currencies. This isn't an earthquake, it's erosion. It happens day by day, deal by deal, until the old system simply isn't the default anymore. And by the time the American public wakes up to the change, it may be too late to reverse. Now imagine this scenario unfolding while America is gripped by electoral drama, economic strain, and growing domestic instability. The distraction is perfect, the timing is surgical, and the shift in global financial architecture is already well underway. The question is no longer if the dollar will lose dominance. The question is how fast and how devastating the fallout will be. Global markets react, and the ripple hits Wall Street. When the tremor starts, it doesn't stay confined to the epicenter. The moment China began its large-scale sell-off of US Treasuries, the shockwaves began to seep into the veins of global markets, not as a panic, but as a subtle shift in sentiment. That's the danger with financial warfare. It doesn't come with sirens, it comes with whispers. You don't see explosions, you see indicators flicker, spreads widen, risk premiums grow. Wall Street, despite all its algorithms and predictive models, still moves to the rhythm of confidence. And confidence, like capital, is leaving the room quietly. It started with a rise in Treasury yields. As demand drops, the price of bonds falls and yields increase. That alone is enough to spook markets already jittery from inflation concerns and the Federal Reserve's tightening stance. Investors know higher yields mean higher borrowing costs, not just for governments, but for businesses, households, and institutions. It tightens credit conditions and compresses growth projections. Suddenly, companies that once enjoyed cheap capital begin to struggle with refinancing. Tech firms lose steam, consumer confidence dips, the entire economy starts to feel heavier, and it all traces back to the moment a major player like China decides to unload. But it doesn't stop at bonds. Equities respond next. Volatility indexes like the VIX spike, signaling fear in the system. Traders start hedging positions. Institutional investors rebalance portfolios, and a cascading effect begins. Wall Street might try to shrug off the initial movement as noise, but the message is already circulating. If China is pulling out, maybe others are thinking the same. That kind of thinking spreads faster than any virus. It's financial contagion, rooted not in fact, but in fear. And fear is the one element no market model can fully predict. Even commodities begin to react. Oil prices become more volatile, not necessarily because of supply shocks, but because of anticipated shifts in trade settlements. If oil starts moving away from the dollar, pricing mechanisms are disrupted. This affects hedging strategies, contracts, and investment decisions across entire sectors. Gold, often seen as a safe haven, starts to rise. Central banks accelerate their purchases. The trend reinforces itself. The world is rebalancing, and Wall Street is caught trying to interpret signals in a language it hasn't spoken fluently since the Bretton Woods system was dismantled. And then comes the global component. Emerging markets, many of which hold US debt and rely on dollar-denominated trade, begin to feel the strain. Currencies fluctuate, capital outflows intensify, and debt servicing becomes more expensive. Sovereign risk increases. For financial institutions exposed to these markets, the risk is real and immediate. Suddenly, what began as a bond dump in Beijing turns into systemic risk in Johannesburg, São Paulo, or Jakarta. Global investment funds start reallocating, fleeing volatility, and tightening their criteria. The system contracts, liquidity dries up, the pressure returns full circle, back to Wall Street, where it all connects. In this scenario, even the US banking sector can't hide. With interest rates rising and bond values falling, balance sheets weaken. Banks that overexpose themselves to long-duration treasuries start facing unrealized losses. Some will manage, others may not. We've seen similar cracks before. 2008 is still fresh in many minds. And though the current crisis may not stem from bad mortgages, the anatomy of collapse often rhymes: mispriced risk, delayed reactions, and the illusion of stability right before the storm. What's even more dangerous is that this time, the disruption isn't born out of internal mismanagement. It's externally triggered, surgically deployed by a foreign power. China hasn't just bet against US treasuries. It's testing the structural integrity of the global financial system and watching how it responds. It's playing a long game, where every ripple it creates has the potential to unsettle confidence in America's ability to lead the global economy. And once confidence is lost, no rate hike or emergency fund can fully restore it. Investors are now forced to think differently. The old assumptions that US debt was sacred, that the dollar was untouchable, that geopolitics didn't affect portfolios, are no longer reliable. Analysts are rethinking exposure. Wealth managers are advising clients on diversification not just for profit, but for survival. The markets, once built on the myth of unshakable American supremacy, are now recalibrating around a multipolar world where economic influence is contested daily, not just in summits or treaties, but in currency swaps and bond sales. So the question isn't whether Wall Street has reacted, it's whether it fully understands what it's reacting to. Because this isn't a cycle, it's a shift. A slow, deliberate reordering of financial power that started with a quiet move in China's central bank and has now echoed into every trading floor, boardroom, and investor's mind across the world. The old maps are fading, and new routes are being charted, ones that don't necessarily lead back to New York. If you've made it this far, we truly want to know, how did this video speak to your heart? Take a moment and comment below. I enjoyed the content, and share how this message resonated with you personally. Your voice matters here, and your insight might inspire someone else who's also searching for clarity in these uncertain times. Don't forget to subscribe to the channel so you never miss out on powerful, eye-opening content like this. Leave a like to support this mission of bringing truth, depth, and perspective to a world in need of understanding. And of course, make sure to watch the next video already waiting for you on the end screen, because the journey of awareness doesn't stop here. May God bless your life abundantly, guide your thoughts, and strengthen your purpose as we navigate this complex world together.